This is just a short follow-up video to the last video where we talked about AFDA. In the last video we really just focused on how to calculate AFDA. We focused on accounts receivable and how they needed to be shown at a net value on your balance sheet. And the three accounts, allowance for doubtful accounts, your allowance for cash discounts, and your allowance for sales returns. We talked about how those three were all contra accounts to your receivables and how they all reduce the value on your books, so that the net figure you show for AR is more realistic and representative and relevant to your financial statement readers. It shows them the gross amount that you're owed, less any of the things that you expect might change that figure, and it shows them the net figure, which is effectively what you expect to receive, right? So we talked about all that. This short video, all I want to really quickly discuss is the journal entries that you're required to know for allowance for doubtful accounts. In the last video we didn't really get into that, so I just wanted to quickly cover them off. The first journal entry on this slide you should recognize quite well. This is your standard, your typical bad debt entry for a given year. So whether we're using percentage of credit sales or the aging of receivables method, you would need to use this journal entry to book bad debts expense. So the common format is to debit bad debt expense and to credit AFDA, right? Allowance for doubtful accounts. It doesn't always need to be that way, right? It could be reversed. If you remember, if you think back to the last video when we talked about the aging of accounts method, we said that the bad debt entry was a function of the number you calculate from the aging schedule less what's already in your AFDA, okay? So the difference between those two numbers typically is your bad debt expense. Well, if you've already got too much in your AFDA, your adjustment for bad debt expense isn't going to be a debit to bad debt and a credit to AFDA, because that would only increase the AFDA account further. If we need to reduce AFDA, you could actually need to reverse this entry and debit AFDA and credit bad debt expense. So that's why I say that's the typical format, but it could be reversed. The second entry that we need to talk about is writing off an account. So at some point you're going to get to a position where you finally decide that, hey, this customer is never going to pay us. I'm sick of seeing John Smith and the fact that he owes me $10,000. I'm sick of seeing that on my aged receivables listing. He's never going to pay me, so we need to get it off our books. So the way that you get John Smith's receivable off your books, if you think about it, there's that receivables represented on our books in two locations. The most obvious is accounts receivable. We're going to have something in the AR subledger that says John Smith owes us $10,000. So that 10K is sitting in AR, right? The other spot it's located is in AFDA most likely, because we've probably, if we're at the point where we're writing this account off, we've probably already allowed for it. So we've already done a journal entry that would have debited bad debt expense and credited AFDA. It's been a part of one of those entries somehow. So it's sitting in your AFDA account and it's sitting in your receivables. So to clear it off our books, what we need to do is credit receivables to get it out of receivables, and we debit AFDA to get it out of the allowance account, right? So effectively, by doing this journal entry, there's no more traces of John Smith's $10,000 that he owes us. All right, so that's the second entry you need to know how to do to write off an account. So writing off an account isn't recording the bad debt expense. It's getting to the position, or to getting to the point where you actually want to get it completely off your books and you don't want to see the receivable anymore. Okay. The next set of journal entries you'll see there is, so what do we do if John Smith actually comes in and pays us at some point unexpectedly, right? So we did this second journal entry here to write off John Smith's account. So there's no more John Smith on our receivables. But let's say on a Tuesday afternoon, out of nowhere, John Smith walks in and he pays us $7,000, right? We're not expecting it. We've already written off the account. So how do we deal with that $7,000 payment? If you think about it logically, we can't just debit cash and credit AR, because John Smith is no longer in AR. When you go into your accounting system to try and post it, you can debit cash, but when you go to apply that payment, there's no account there with John Smith owing us money. All right? So what we need to do is we need to first reestablish the receivable. And the way we reestablish the receivable is to reverse the write-off. And if you remember back to chapter 3, when we talked about reversing entries, Reversing entries were simply just the exact opposite of the adjusting entry. So same situation here. To write off the account, we debited AFDA and credited AR. So to reestablish the receivable, we just do the opposite. We debit AR and credit AFDA, right? We're reversing the write-off. There's one trick here though, right? And let's look at this John Smith example. We said John Smith owed us $10,000 and we wrote that off here in journal entry number 2, okay? John Smith came back in and now he's paying us $7,000. He's not paying us the full $10K. So when we reverse and we reestablish the receivable, we're not going to reestablish the full $10,000. We're only going to reestablish the amount that John Smith is paying us. So in this case, we would debit AR for $7K and credit AFDA for $7K. Okay, so we reestablish that receivable. Once we do that, we can now record the cash receipt. So it's a two-step process when John Smith comes back in to pay us. We set his receivable back up, and then the final entry is to debit cash and credit AR. Okay, so we set his receivable up, and then we clear it right back out to recognize the cash. But now that we've reestablished his receivable, we have something to apply it to when we go to our cash receipts journal. We can apply it against John Smith's account, and the $7,000 that it's saying he owes us. That other $3,000, the difference between what he did owe us and what he paid us, we're going to leave it written off our books unless we have reasonable means to think John is going to pay us. We're probably going to leave that off our books until John comes back in and makes another payment. All right? And that's how those different journal entries work. So you have to be able to do the bad debt entry, you have to be able to write off an account, and you have to be able to reestablish an account and receive payment for something you've previously written off. All right?